Hello, everybody. So today's video is entitled Fallen Digital Asset Treasury Companies, What to Do? What are kind of scenarios going forward? And, what is happening? So, of course, the decline has been unprecedented. It's been insane. The decline has been insane. But why has it been insane? Well, it's because Bitcoin has been insanely weak. Nobody expected this much of a drop, especially with this positive of a macro backdrop. I cannot possibly understand or explain why this is happening. The macro is as good as ever for Bitcoin. We are going to have the end of QT in December. This should be the strongest part of the bull market. And it seems like maybe we never had a bull market, as some people are starting to say, but the narrative October, November, all of these narratives, we had the polar opposite. And this is, of course, going to be the worst November for crypto and perhaps even for stocks since 2028, since 2008, unless we get a rally. So it caught everybody by surprise. And obviously, and that was always the deal, and this is always what I've said in my videos, if you don't fundamentally believe in Bitcoin, if you don't think crypto is the future, then obviously these companies, you need to stay away from them as much as possible. Because actually, if you look at STRD, it performed the way it was supposed to under the circumstance of Bitcoin dropping to 84. But keep in mind, Bitcoin actually dropped to 80, like 80,000 and a few $100. So STRD behaved the way it is supposed to. If you look at the exact same date, okay, IBIT, exact same date, IBIT dropped 32%. STRD dropped 52%. STRD is about 1.5x, 1.5 the performance of Bitcoin. Nothing is out of the ordinary. It's working the way it's supposed to. People are mad at STRD when they really should be mad at Bitcoin and what's going on with Bitcoin. The problem is with Bitcoin dropping, in my view. It's not the company. And so as a long-term holder, I am fine. And that's solution number one. What to do? What's the answer to that question? Solution number one is just hodl. Personally, that's what I'm doing. I still believe in Bitcoin. Nothing has changed. If we are heading through a period of bear market, well, I guess MSTR will be trading at, I don't know, a 0.6, maybe 0.8x MNAV. And if you can withstand that for 6 months, 8 months without any obligations, if you do stocks like you should, long-term investor, no margin, very little options to no options. I mean, even margin, you can do a teeny tiny bit margin at the bottom of a drop. You could potentially do that, but do very little of that. If you are that type of person, then nothing has changed for you, and all you need to do is go to the forest, delete Robinhood, delete the app, and to me, MSTR in my view will recover. It just takes BTC to recover first. First, Bitcoin needs to recover, and then MSTR will recover in my view. And stretch is broken right now. There's a liquidity problem. It's everything has been sold off, so obviously stretch has been sold off too. But stretch, in my view, will inevitably return to 100 because we have a rate cut. I mean, it seems it's back on as of yesterday. The rate cut for December is back on, so we may get a 70% chance, 71% chance of a rate cut. And so you can see Saylor built the company to resist a bear market. And, in 2002, during the crypto winter, they were still buying Bitcoin, albeit very little, but they were still buying Bitcoin. I expect that this week, there's not much they can do. I expect they'll be buying very little Bitcoin. Maybe they issued a little bit of Strife. Maybe they issued a little bit of Strike. So they could be buying a little bit of Bitcoin this week, but very little. I expect a very small buy. All you can do is just sit tight and wait. And by the way, stretch, this is what I've always said, but stretch, Saylor will force it back to 100. And how do you do that? Well, if you get a rate cut, that's 0.25 basis point, which makes this yield, more attractive by 25 basis points. And then what if he increases the stretch yield to like 10.75? Well, that's a 50% basis point thanks to the Fed and thanks to the increase of the yield. If you have that going on, logically, the stock should rise, right? When the rate goes up, that stock is going to get back to 100 inevitably because people are going to find it much more attractive. And so in my view, we're going to get back to 100. This stock, of course, Saylor arguing that it should really be rated like an A-rated instrument, type instrument like, I don't know, an Apple treasury or an Apple debt or something like that, because they have 4.4 times the Bitcoin backing the instrument, right? So as he says, if Bitcoin doesn't go up, we can still pay the yield for 80 years, even if Bitcoin doesn't go up for 80 years. So that's the thesis behind that. I think a lot of people are catching on. I think Wall Street is somewhat scared, hence that note from JP Morgan saying, oh, maybe they're gonna get excluded from MSCI, and kind of, convoluting the two, like MSCI and QQQ. Yeah, QQQ is not MSCI, right? But it's like when you write if you want to write a hard-hitting piece, you can just like conveniently add in the sentence MSCI and QQQ. If and you just put QQQ together, like QQQ is the big deal, and MSCI has nothing to do with QQQ. But like the article made the connection between the two. So I don't understand that. I think Wall Street is scared. I think these instruments are going to catch on. So that's solution number one, is HODL. Solution number two, and this is a new money solution, and this is something that I find more and more compelling, is why not buy one of the Prefs? Why not buy one of the Prefs? And there's a big advantage to that, big advantage being that, of course, the yield is return of capital. It's a ROC dividend, which means you don't pay taxes until your cost basis is down to zero, which roughly means it's gonna be about 10 years until you start paying taxes for the first time in these dividends, because the yields are about 10%. And there's a lot of Prefs, and it depends on your risk tolerance, but to me, the best Pref to me is Strike. Strike is what? You get upside from strategy. And so, of course, Strike looks bad right now, because there's only $17 worth of call option embedded into Strike. So remember, Strike, once strategy hits $1,000 share, 10 shares of Strike will be worth one strategy share. So there's an embedded call option, a perpetual call option embedded within Strike. That is the magic of this stock. You still get the explosive upside of strategy. And if you happen to believe that strategy will one day be a Max 7 company, which is my standard belief here. I think at some point strategy will be one of the largest financial institutions in the world. If you believe that, you still want to keep that upside, but you want to have a downside protection. Well, I think Strike is the best instrument for that. And case in point, I'll just show you. Of course, over the same period, so the epic crash we've had in Bitcoin from 126,000 the night before October 6th to 80,000 yesterday, right? The epic crash, strategy dropped 52%. If you look at Strike only dropped 23%. For the growth investors that we are on this channel, 23% is like a walk in the park. It's not that much for us growth investors. 50% starts to hurt for everybody. See, 50% hurts much more than 25% or 23%. Well, I guess it's even 20% because it's up 2% in after hours. And of course, the big advantage of Strike is, even though the instrument was designed to pay 8% fixed, right, when it was issued at $100 par, if you actually look at the stock, it's actually yielding right now, because it's been dropped so much. It's yielding 10.46%, tax-free for the first 10 years, right? Return of capital. So pretty darn outstanding to me. And this stock on October 6th was pretty much trading at par, trading at 98.9, $100 par, right? So $1 less than par, and it dropped 22%. But strategy had a way worse performance. So if you want to remove some of the volatility from the portfolio, I think Strike is a great instrument where you keep the odds, in my view, the high odds of very long-term gains that are super good, while reducing the volatility short-term and being able to sleep. I mean, depending on how used you are to that. Now on this channel, like we own IMS on this channel, so we're very, very used to the volatility, right? Or Tesla, like, anyways, Tesla, IMS, MSTR. If you look at the volatility of these stocks, it's been very similar. It's been insane, just insane. But if you want to have a 10x, you need a stock that's able to grow 50% a year. That's the only way you get a 10x, a stock that's able to go up by 50% a year. And if you want to own a stock that goes up 50% a year, that also means that it's part of the deal that you accept that the stock can also go down 50%. Volatility is, over the long run, volatility is to the upside. But over the short run, you're going to have that same volatility to the downside. These stocks are where all of the activity happens. You may remember the famous Amazon story of, having to go through 17 or 16, 80% plus drawdowns. So Bezos, lost his wealth like 17 or 80 times. He lost 80% of his wealth on his way to 100 billion. Right? It's the nature of these volatile stocks, anyways. So that's solution 2. Enough about solution 2. Let's talk about solution 3, and I will explore this more in December. Now, if there's a lot of countries in Europe, y'all are lucky in Europe. There's a lot of countries in Europe where you can just sell. You can sell at noon and buying back at like noon 05, and good, you booked the tax loss harvesting. I know France is like that, for example. You can just sell it for a second and buy it right back, and boom, you booked your tax loss harvesting. In the US, it's not like that. In the US, you have to not own the asset for 30 days, which means that anything can happen in 30 days in Bitcoin. So, I want to be exposed no matter what, because if anything has shown to us, if this period has shown us anything, is that you can't predict when Bitcoin pumps or dumps. We can't predict. Everybody was predicting it would go up. It didn't go up. You cannot predict, right? For all Bitcoin is going to go up 30% when everybody's so bearish. So it's not predictable. So of course, for the US-based investor who believes in Bitcoin, I believe not being exposed to Bitcoin for 30 days is very, very, very risky, because you may miss the 5 best days of the year for Bitcoin on those 30 days that you wait to buy back the assets. So there's another solution for tax loss harvesting, which is simply buying a different company, buying a different asset. So Metaplanet is a hotel company. They have one hotel. STRD is a business analytics company. They have a business analytics software. These two companies are different. What does that mean? You can sell Metaplanet. You never get back into Metaplanet. You take your loss, your 50% loss, and then you can put it into STRD. And you can see, if you look at the pair, the drop from one to the other is essentially the same. Metaplanet dropped 50%. I guess STRD dropped 53%. So maybe a 5% delta, not that much. But, depending on your loss, if you bought higher, that could be very compelling to do some tax loss harvesting, especially if you're in a higher tax bracket, if you're in a higher capital gains bracket. This could be very interesting to just swap between highly correlated assets that are different operating companies. So DATS are very correlated, but they are distinct assets, right? And so the investor can swap from the one to the other. You cannot do that from IBIT to FBTC, right? You can't swipe from a Bitcoin ETF to another Bitcoin ETF. You can't do that. You can't tax loss harvest that. But these are different companies. They are different operating companies. They do different things. Another thing you can do is you can swipe from Metaplanet to, say, a miner, right? Mining Bitcoin or Coinbase even, right? Coinbase being an exchange. A Bitcoin exchange is different from a Bitcoin miner, is different from a treasury company. They do different things, so you can entirely exit and enter another asset that is just as correlated. And so right now, if the end of the year 2025 is turning out to still be this bad in December, if we don't have a holiday rally, I will decide right after Christmas on December 26th, roughly, is because you want to wait for the trade to settle. So I make these decisions on December 26th. Like, I don't know about you, but me, December 26th is when I make these decisions, and so I will let you know what I'm doing on December 26th. But we'll have to see. If they haven't recovered, then there needs to be tax loss harvesting. I think that's a great strategy. In the meantime, there's a redeeming quality to the tragedy of the fall of digital asset treasury companies, which is sometimes you take a big loss, you can end up writing off a lot of money from your taxes. So it's a wonderful thing, and we can swap between a lot of assets. And continuing this, there's other assets as well. So I want to talk about the miners in a second. So I'll talk about the miners in a second. Of course, you can swap from, say, a Metaplanet to a miner, right? Oh, by the way, don't interpret this as me selling STRD. Like, the one thing I'm not selling is STRD. Like, I will never tax loss harvest STRD. Thankfully, I am nowhere near a loss on STRD, but maybe it could happen. I don't know, but I'm not tax loss harvesting strategy. Definitely, Metaplanet I bought in the $4 range. So Metaplanet, I lost half my money because I bought at $4, right? So Metaplanet to me is a very good candidate for harvesting. Anyways, I want to talk about a few considerations. Ownb. I've spoken positively before of Ownb. I know a lot of people on this channel don't really like ETFs. I understand that, but Ownb, I think, has been able to really smoothen the performance of these treasury companies. So since May 23 to May 21, it's only down 21%, which, like I said, is nothing. It's a walk in the park. Not much at all, and it's able to smooth this performance. Because if you look at Ownb, they actually own a bunch of different companies. Like they own the miners, they own Cypher Mining, CleanSpark, Riot. So this is the AI HPC. They had quite a bit of this. They own Metaplanet, of course. They own STRD, and they own Mara. And so I like the smooth experience of Ownb, and Bitwise is very, very involved and very deep in the space. So that could be a solution to swap into, right? A stock to swap into where you smoothen the performance. And then I briefly want to talk about the miners. These poor miners have suffered from both the crypto crash and the pseudo AI bubble narrative that has hurt the market this past month. If you think AI is a bubble, I recommend that you listen to the NVIDIA call and make that opinion for yourself. In my view, AI is underhyped. To quote the former CEO of Google, Eric Schmidt, AI is actually underhyped. I mean, the NVIDIA call, like really quickly, one of the things that really stuck me is talking about recommender system and how all recommender systems are going to move to GPU-based recommender system. This means that people who are on Instagram are about to be way more hooked to Instagram. Instagram is about to be so much more addictive for Facebook because and Amazon is about to be so much more likely to show you a product that you want to buy and you can't resist. Why? Because recommender systems are moving from CPUs to GPUs. And so get ready for YouTube to be so much more addictive, for Amazon to sell you ever more stuff, for TikTok and Instagram to be an app so addictive, like cigarettes are not addictive at all compared to that, because they're going to move to GPU-based recommender system. That struck me, like that struck a chord with me. Like, of course, I mean, this is going to be just insane. GPUs, and of course, okay, this is a topic for another video, but you also have to realize that we're getting into a world where the videos, the memes, whatever, are also going to be AI generated. So we can expect AI generated content which hooks you. So not only will the recommender system will not only do a better job matching a product to your attention, or an ad to your attention, or a post to your attention, but that post, that ad, or that product may be AI generated, right? Anyways, it's going to be insane. It's going to be insane if you ask me. And you can see all of these stocks, they dropped a lot. Cypher, I need to study Cypher. I'm interested in Cypher right now, down 42%. Mara down 56%, CleanSpark down 58. Is it 58? Yeah, 58%. And then Riot down 44%. So all of these companies are, well, Cypher is a definite AI play. Cypher signed a deal with Google, and the market entirely forgot about it, and now the stock is down 42%. But in my view, like Riot and CleanSpark, if I look at the location of your data center, Riot has a very large data center south of Dallas, like 50 miles from Dallas. CleanSpark has two large data centers, one near Atlanta and one near Memphis. In my view, these are prime targets for hyperscaler deals, and they're trading. I mean, they're trading close to the value. I mean, a little higher than value of their bag, but Mara, for example, is trading below than the value of their Bitcoin bag. And Mara, for example, they did an outstanding acquisition, the Exion acquisition of the EDF data centers in France. Like, it's absolutely outstanding. I don't know how they got a deal like this. And they have a different strategy for AI. I think Mara, the market doesn't like Mara because Mara, if you look at the CEO, it's a little scattered. The earnings call was very scattered, kind of all over the place. But they're going after other forms of compute and dispatchable compute. I think Mara is an interesting play. I think the initial reaction that took the stock to $25 was the correct reaction. And of course, Mara, it really helps that you get it for free. Like you get the underlying at Mara for free because the bag at Mara is more expensive than the entire company. Their Bitcoin bag is more expensive than the entire company. This is obviously, in my view, an anomaly. So that's solution number 3, tax loss harvesting, swapping among these highly correlated assets. And then solution number 4, which will seem to the Bitcoin maxi like the wild solution, but you know, I don't think this video would be complete if I didn't talk about altcoins. So solution number 4, could it be going the altcoin route? And in my view, in that sector, the best play is DeFi Development Corp. It is my favorite in that sector. It dumped so much. It's now trading at 70% of the value of their Solana bag. And keep in mind that. So a lot of the Solana they actually bought a locked Solana, and they bought it at a discount. And then you get a further discount right now compared to what they bought it. You get a 30% off, right? But here's the beauty about Solana. A Solana company, a Solana treasury company, or an ETH treasury company for that matter, to a lesser extent, they don't need to do ATM. There's zero need for ATM because you just earn a native yield on Solana. And in the case of DeFi Development Corp, because they run their own validators, because the team is from Kraken, right? They knew Kraken being a leading exchange, so they know validators, they know that stuff. They earn between 10 and 11% on their stake Solana, 10 and 11%. So they earn more than, say, staking your own Solana on Coinbase or buying a staking Solana ETF, a staked Solana ETF. They earn more. They can earn more. So here, the DeFi Development Corp, the treasury company route makes perfect sense because they can earn more than you could earn on your own. You get it at a discount. And in the case of DeFi Dev, they're very innovative. They launched the preferred. They gave warrants to the shareholders not too long ago. And they're developing their model across multiple markets, multiple countries around the world. They have one in the UK, they have one in Korea, and they're taking participation stakes. I think DeFi Development Corp is very undervalued right here. I like it very much, but it is way out of the risk curve, of course. It is way out of the risk curve. And the problem is whenever you talk about other layer ones than Bitcoin, you get into, you know, clicks and, you know, tribal confrontation among different groups in crypto. And of course, the big confrontation is ETH versus Sol. And you know, not to be technical, but in my view, Solana is much better than ETH. It's the better blockchain. It's got a better coding language. Rust is known as a much better coding language than ETH. It's got a lot of developers. And you know, I think as far as we're concerned, because this is a finance channel, this is a stock channel, as far as we're concerned, the ETH yield is just too low. The staking yields on ETH are like 3% or 4%, so 3 or 4% versus 10 or 11%. So I think the delta between the two more than plays into favor for DFDV or perhaps another Solana treasury company, like for example Upexi, which is even cheaper. But I like the team at DFDV better than Upexi's team, because Upexi seems, I mean, I don't know much about Upexi, but I like DFDV team better. And also there is an overhang, there is an issue with ETH in my view, which I think part of the reason why Ethereum is not as expensive as it should be is because of a lot of the value that should have flowed to Ethereum actually ended up flowing to Base. Base being the Coinbase layer 2 for Ethereum. So Coinbase actually operates, and a lot of the value accrues to Coinbase actually on ETH. And so actually, I think if you want to play Coinbase, if you want to play the adoption of stable coins, you know, ETH treasury companies, sure, they could be a play, but perhaps a better play is Coinbase. Coinbase dropped a lot recently. The stock was over $400 not too long ago. It's now trading at the same level that it was more than a year and a half ago. So Coinbase, I also find compelling. And if the market gets back to its senses, And I need to stop, and I don't feel like I have to, comment every day on the crazy movements. If the market gets back to its senses, I think Coinbase would be prime for an analysis. I think also USDC Circle would be prime for an analysis if you want to bet on stablecoin. And don't forget, stablecoins are going to benefit Solana as well. The stablecoin apps are going to be built on Solana as well. Stablecoins move on Solana, they move on ETH. So, anyways, if you're feeling like the risk curve is for you, you might want to look into this one. But as always, of course, this channel is not financial advice. This channel is not investment advice. This channel is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.